Okay, so moving averages. So moving averages are one of the indicators I'm going to show you guys to use. And what an indicator is basically just like a mathematical or like a robotic system or algorithm that uses numbers on the charts to analyze what's going on with the charts. All right, that's just top of my head some definition, but let's actually go into it. So if you look up here, we've got this indicator tab up here that we click, and we have all these different built-in indicators that TradingView allows us to use. Okay, now there is a lot of indicators to use. Okay, some look absolutely crazy, like this one. Okay, just ridiculous. And you know, some can be as simple as something like this. Okay, now whenever you add an indicator, it always comes up to the top left. And then on the settings, you can actually work out all the details of the indicator. Okay, we're just going to delete that one. So the indicator I'm going to show you to use is the moving average. Okay, so it's called MA. And there's usually two moving averages. So I'll show you because just in case you get confused. Exponential, and there's also simple, which is usually here. But we always use the exponential one. Okay, and we're going to use two of them in this example. So I've clicked it twice and it popped up on my screen. All right, now what this moving average indicator is basically is it's working out over a period of time, so over a length of days, where is the average price been? Okay, so see here we got the number 9. So I just click settings. And come up here, we've got the number 9 on input. So that means over the last 9 days, where's the average price been? So what is it's calculated average price over the last 9 days and put it into a line. Simple enough, okay? Now, what does this tell us? Okay, so the numbers, the length that I use on my time frame. So I use 4-hour time frame and the 50-minute time frame for entries, and overall 4 hours for area value. Okay, so I use the 50 moving average. Okay, and I also use the 100 moving average. So these are the two moving averages I use. They work for me the best. They're actually pretty popular. I think a lot of people use these ones too. For trend trading, but they seem to do the job, so I use them. Okay, now there's sort of 3 really important things to notice with the moving averages. Okay, the first thing is that if they tell you where the average price has been, right, over these period of times, over 50 and over 100 period of time, then if price is currently above or below the line, then it shows you where the current trend is. Okay, so just bear with me, right? So if this is the 2 lines, right, where price has been over a period of time. So this is the average price, okay, over 50 and 100. Now, if price is below the moving averages, okay, where it is in this example, we can expect the trend to be downtrending, or we can say we're actually in a downtrend, okay? Now, if the price is above the moving average, we can say that price is in an uptrend because it's moving above the moving averages, which is those 2 lines there, okay? Now, if price is sort of crisscrossing, so, you know, moving like this, let's see if there's a better example. Okay, so crisscrossing, like moving like in and out, in and out, in and out, that means we're just consolidating. So the price is consolidating, okay? So moving averages allow us to help us identify the trend, okay? If the moving averages are crisscrossing, then we're in a consolidation. If price is below the moving average, then we're in a downtrend. And if price is above the moving average, then we're in an uptrend. Okay? That's basically how it works. Now, a few important things to note is that the greater distance between the moving averages, the stronger the trend is. Okay? So if you see like how they're close to each other, it means that the trend isn't really that strong, or isn't really that overpowering. Okay? But if you notice here, when, you know, the second the moving average starts to grow in size or get all further apart from each other, the stronger the trend is. Okay, like this one here, we have a massive, you know, gap between the two. The trend was crazy to the downside. Okay, the bigger the gap, the bigger the trend, and the stronger the trend. Okay, let's see if we can find another pair because this doesn't seem like working too well. Okay. So this example here, if I'm trying to trade the trend, well, if the moving averages are, you know, if price is below the moving averages, obviously we're in a downtrend. But if the gap is big too, then we're in a pretty strong downtrend. Okay. And as you know, we said before, if it's crisscrossing, we're consolidating. So you can sort of, if you have trouble with identifying the trend, or if you want another confluence, okay, the moving average is very, very good for identifying the trend, how strong the trend is, and where might the trend end next. Okay, usually when it gets closer to each other. All right. What I will say is that an important thing to note is that when the trend does change, we have the moving averages cross. Okay. Now the second the moving averages cross, so we've got two examples here. Okay. We had a massive strong uptrend, and we had a moving averages cross, and we had a really short downtrend. Okay. Then we had a moving averages cross, and then we had a strong uptrend. Then we have the moving averages cross, and we had a minor downtrend, or that was the beginning of a downtrend. Okay. So what you notice is that, if this is a downtrend here, in order for the uptrend to be overpowered, and in order for the uptrend to occur, we need to see the moving averages cross, and that cross will allow us the information that a new trend is going to happen. Okay, so crisscrossing is very important, and you can use this on all different time frames. So for example, we're on a 30-minute time frame. It doesn't work as effective because there's a lot of information going on, but we really look for this time frame for entry. But for example, this crisscross happened, then we had a massive downtrend. This crisscross happened, then we had an uptrend. Okay, and then we had downtrend, uptrend. As you can see, it consolidating a bit. Yeah, price is consolidating within this range. And the second we had a breakout, price was really below the moving average, and the wider the gap, the stronger the trend. Okay, so you can sort of work out a few things that if you've got a really wide gap and a really strong trend, price is really below the moving averages, we're not crisscrossing, then it's gonna the trade, whether it's a seller or buyer, is gonna really be in your favor because you're catching that big momentum. Okay, so moving averages are really important, and I use them all the time just for an extra. If I see this going on in the chart, probably not going to take a trade because I know it's consolidating, but the moving averages help me see that. So I use them a lot, and the 50 and the 100 moving average, exponential moving average, is the best way to do that. Okay,